Well, it hasn't been a quiet summer at all, has it, Husey? So much for the post into school holidays and everything calms down. How were your holidays?
They were really good, actually. We were
Cyprus
in
again?
for the listeners. We were in Cyprus. I know you like to talk
Same
about my
hotel.
holidays. Same hotel. It was lovely. It was the first time. Yeah, we got on the flight, and it felt like getting a flight pre-children in that I could actually relax and watch something. The kids were
Watching their devices.
they're watching their devices. To be fair, Charlie's been. I know they're playing cards. Charlie's obsessed with top trumps. He's got supercar top trumps.
Oh, we played dinosaur top trumps all the way through our holiday.
Did you?
Yeah, which is great fun.
We've got the dinosaurs and the shark ones as well.
Okay, I was going to get the tractor ones actually. From Amazon.
Charlie's supercar top trumps. He has a notepad, and he put them all in order in terms of the favoured cars.
Amazing.
I think they were in horsepower order to start with. So
Amazing.
he's questioning why Daddy doesn't have a McLaren or a Ferrari or something like that.
No, that's because you're sat here with me.
Yeah, exactly. Daddy, why do we have a Volvo? Well, son.
Oh
Yeah,
dear.
there we are. No, but it was. Yeah, I felt quite stressed before holiday, and actually, 2 weeks away. As much as I took my laptop and I was doing bits and bobs, getting sleep, eating properly, bit of sun, I have come back quite refreshed.
Oh, well done.
Until Donald Trump did Donald Trump things, but there we are.
We'll talk about that.
Yeah.
But it hasn't really been a.
And your holiday was good?
Well, yeah, much the same
Corfu.
really. Corfu, nice hotel, top trumps. The kids loved the kids club. They had a really good bunch of
Did they?
young sort of students who were looking after the children, and
Nice.
they just wanted to go back every single morning, and they were very, very sad when we had to leave. So that was quite nice. So we, Tony and I had a few hours of
Chilling, reading books.
Exactly.
Yeah.
So it was good.
Listening to podcasts.
I listened to a couple of meetings. I listened to the morning meeting every morning. It was quite nice. It was 10:30 out there when the morning meeting was on, so it's like sort of perfect. Kids are in
On the sun
kids
lounging.
club. Exactly.
Very good.
No, it's all right. So good to be back, but there's lots going on. So we've got a few things to talk about. It's just the two of us today, but soft title for the episode is "So Much for the Summer Lull!" exclamation mark, which I think is, pretty apt. And
Episode 53, John.
is that right, Alex? Episode 53.
We're getting through them, aren't we?
We are.
We'll have when we get to 100, we'll have to have a glass of champagne.
Well, let's get cracking then. Hello, everyone, and welcome to Taking Stock After the Bell. As we've just pointed out, episode 53. So much for the summer lull. A few things to talk about. We are going to start, however, with US economic data, and in particular, last Friday we had the so-called non-farm payrolls, which is a monthly number of how many jobs are created. And the number itself was fine, was at 140 something, which is roughly in line. But the real kind of shocker for the market was that the previous 2 months' data points were heavily revised down to basically zero. So the chart we're going to put on the screen here is I think it's a 6-year chart of the monthly payrolls numbers, and we can see we've excluded the negative ones because it distorts the chart totally, but we had massive negative numbers in 2020 at the COVID moment, and then we had the positive numbers as the recovery came about. But we can see how that number, if you sort of eyeball it, how it's been trending down, and in particular we can see the two numbers prior to the latest one being kind of virtually zero. And this caused a bit of stir in markets, didn't it? And it suggested that perhaps the US labour market hasn't been anywhere near as strong as people had thought, and that has consequences for the Fed and interest rates, as well as for companies. And the S&P last Friday, or the US market, was down 2% last Friday. It was a pretty rough day. Yeah. The first kind of big negative day we'd had for a while. And I think so that in itself is interesting. Perhaps what's even more interesting and quite fascinating is that the revisions led to a something of an outburst from the incumbent president of the United States of America, and he fired the head of the Bureau for Labor Statistics, the head statistician of the US.
Poor Erica is gone.
Erica. So she faced the wrath on Truth Social. And she got sacked. So that is that. And he claimed it was all a fudge, and it was...
And I'm going to jump in because this is this is exactly what Trump and the Republicans used to accuse Biden and his party of, which was essentially making up the figures. So what he used to have a go at was they would say the job numbers were better than they were, and then they would quietly revise them down in the months after.
Yeah.
And he said that was against the party, keeping Biden in power, trying to show that the economy was stronger than it was. And that's exactly what the Bureau of Labour Statistics has done, which is they've revised them downwards. So he's essentially sacked someone for doing the same as what he was accusing his opposition party of doing, which he said was trying to benefit them. So it appears the only thing Trump accepts is a good number and then a revision upwards.
Yeah.
Anything else he thinks is unacceptable. And I think it's, we're now getting to a stage where, can we even trust the data if he's we don't know who's going to go in yet, but if one of his mates goes in, how can we sit here and have the view, or how can we be comfortable with the data or the revisions that are being printed? For years we've had to go at China's data to say, it's not accurate, it's manipulated, and this is exactly what essentially the most powerful man in the world is now doing.
Yeah.
It's a real worry.
You open up a few cans of worms there for me. So the second chart we're going to put up now, Alex, is of the revisions. So this squiggly line here shows how the first and second month are revised either up or down. And we can see pre-COVID, the revisions, they're quite narrow distribution and they're sort of equally distributed up and down, right? So you'd think that they were doing quite a good job.
Yeah.
Obviously, the revisions during COVID were pretty hefty because we were all stuck at home and whatever else. But you can clearly see since 2022 that the scale of the revisions have got wider, i.e. the initial number has been revised by a greater amount in the following months.
Yeah.
And there's also another chart doing the rounds, which unfortunately I couldn't find, but of basically how do the statisticians, I can't even say it, how do they come up with a non-farm payrolls number? Well, they send out surveys and they literally send out like questionnaires to companies saying, can you fill this in, please? How many jobs have you created or destroyed?
And are they paper surveys?
Historically, they were. I assume they still are.
Yeah, they probably still are.
So historically, there's a chart doing the rounds that the response rate to the survey was 90%. And that response rate was really consistent. Post-pandemic, that response rate has fallen catastrophically to the point it's now 50 or 60%.
Yeah.
So if only half the people are replying to the survey versus 90%, then your data is going to be less accurate and more likely to be prone to revisions.
Yeah. Yeah.
And if we take this one step further, it's actually the situation is even worse in the UK, where there have been some really high-profile issues with the unemployment labour market data. The Bank of England have moaned about it. They've been up in Parliament. The chief statistician has been in select committee inquiry hearings. Yeah. And so this isn't just a kind of a US problem, but it is a massive problem because the Bank of England and the US Federal Reserve want to set interest rates based on what they think the economy is doing. And if the data is all skew-if, to use a...
Well, if they're having to wait months and months to get the proper data, then it's too late.
Proper rearview mirror stuff, isn't it? As opposed to just a little bit rearview mirror stuff. So this is quite serious. So there's two issues. One is, the sanctity of the data, and then the second one is the somewhat third world banana republic treatment of a head of a government agency by the incumbent president of the so-called leader of the free world. So it's a really fascinating story to see how this goes. I mean, it sort of reminds me a little bit of in Turkey a few years ago. Didn't President Erdogan, didn't he install his son-in-law as head of the central bank? I mean, it's not entirely dissimilar, is it? So,
but as we were saying before, though, the people responding to the survey, we would, as we discuss, potentially there is bias in the survey. So if there's nothing going on, then I think businesses are probably less likely to respond. But if the response rates are from people that have big changes and feel they need to report them, then that could actually skew the data even more, which is potentially why we have these big swings.
Yeah.
So it's really hard for the market. And I think the only thing it's going to lead to is more volatility in stock prices. And we sort of saw, as you said, Friday was a big down day, and then Monday we had a big recovery.
Everyone's forgotten about it.
Yeah, and I think part of it was the market going, oh, okay, well, if the only reason the Fed are going to cut is because of employment. Mm-hmm. Well, not the only reason, but it's it's a big driver. Oh, well, if the Fed's going to cut, then that's good for markets. So that's supportive. So it's the market's reacted one way, and then it's reacted another way when it's had a bit of a think about it. So it makes life tricky.
It does. Fascinating, no less, but tricky. And that sort of leads us on, talk about the Fed sort of leads us on to the other part of what they use in their decision making, which is inflation. And dear me, have we talked about anything other than inflation for the last 3 years? I'm not sure we have. 4 years. We've got a chart here of US CPI. So the headline CPI is in blue, and it is about, put the thing on the scale, is about 2.7, 2.8%.
Yeah.
And then basically CPI is made of either goods or services, which kind of makes intuitive sense. The goods line is orange or yellow, and the services line is grey. And what's driven the fall in inflation in the last 2 or 3 years has broadly been goods prices normalising after the kind of spikes of the pandemic. We all wanted to buy barbecues and gym kit when the pandemic, so we all stuck at home and we couldn't because they were stuck on boats somewhere. So prices of stuff went up, and it's sort of normalised since. People... the reason perhaps that the Fed haven't cut more aggressively in the last few months is because of tariffs. And DataStream here have got a chart of the US effective tariff rate, which we can see has gone from about 2.5% to 8%. And it's probably heading to about 15, 18%. So it's going to go much, much higher than this once all the tariffs kick in. And people are worried about what's going to happen to goods prices because all of the stuff that the Americans buy typically comes from outside the US. And we can see that yellow line there at the end, goods CPI has just started to tick up. And there was some evidence in the last CPI report, which was out 3 weeks ago, that the tariff impacts are beginning to flow through things like household durable goods and furniture and all that sort of stuff, white goods. Prices just started ticking higher, which is kind of classic tariff. So
I mean, in California, they've obviously had the wildfires, which have been horrific, but they import most of their timber from Canada.
Yeah.
So there's a lot of people, there's a lot of Californians. They're obviously very unhappy with the Trump government as it is, but they're really, they've seen the cost of rebuilding probably rise by 20% as a result of these tariffs. So it's having a real impact on Americans. And I think you're sort of starting to see that a bit in the consumer data.
Yeah, so I think US inflation data is out next week. And again, it's not necessarily the headline number that's important. It's going to be the geeks poring over the detail line by line to see which line items are going up. Car prices again is the other one that might kind of throw a spanner in the works. But on the flip side, services inflation continues to unwind, continues to drop, and services inflation is the biggest component of services inflation is housing costs, and that continues to fall. So, if we get a so-called kind of hot CPI print with loads of evidence of tariff inflation, then it doesn't seem likely that the Fed will be that keen to cut rates in September. Despite, again, to come back to the point about the president, he spent pretty much every day in the last 3 weeks on Truth Social, calling Jay Powell a moron and an idiot. And there's pretty much some of the clips of the meeting they had at the Federal Reserve building was pretty entertaining. Also pretty cringe. So we've got the next Fed meeting is in September. There's a US CPI report next week. There'll also be another one before the next meeting. So effectively there's 2 CPI reports for the next Fed meeting in September. And both, how this tariffs is playing into CPI, we should start to see, if tariffs are going to impact inflation, we should now begin to start seeing the impact coming through. So really important. And on I think I've also put a chart here somewhere of, what the market thinks rates are going to do.
Yeah.
So the blue line here is where the market thinks rates are going to be in December. And the yellow line is where the market thinks rates are going to be in June next year. And they've been actually reasonably flat in the last few months. But market thinks rates are going to be cut twice before the end of the year, and then another 2 cuts by June next year.
I think, wasn't it less than a 30% chance of a cut in September pre the employment data?
And now it's
gone
90%.
up to over 90. Yeah.
So the market is now nailing on a September cut.
Yeah.
But again, to come back to the point, if we get 2 hot CPI prints with lots of tariff evidence, then that might change.
And how's Mr. Trump going to react to that if tariffs are impacting inflation and the Fed doesn't cut?
Well, he's probably just going to shout fake news, right? And probably fire someone else. Yeah. Because he doesn't often deal directly in facts, does he? So a lot of it is hyperbole and playing to his base, which has been his style for a long time.
Of course, he's got midterms approaching, hasn't he? So he wants everything to look as good as it can.
Well, ultimately, he's a guy who spent his life in property investment, real estate, and he likes cheap debt and he likes cheap interest rates. And of course, as we've talked before, the US have a very high debt load, which is very short duration, i.e. they have to roll over a lot of their debt each year. So they want lower rates so that they can roll their debt over at cheaper levels of interest. So this is sort of the big story really of what's been happening in the last week on the macro. And we'll kind of see how it goes from here really. In more sort of cheery news, though, we are most of the way through so-called earnings season.
Here we are.
Companies report results. Our morning meeting is very exciting because we have about 8 to 10 companies every morning to listen to. Whatever this morning, we had AMD, Legal and General, Lancashire, Pfizer. And the good news is here, as this little table from our friends at JP Morgan, 54% of companies in the US have so far reported. 83% of companies have beaten on their expectations for earnings. And the earnings are growing at 10% year on year. So you'd say that was pretty healthy numbers.
Yeah, very.
The other 2 columns are Europe, both European indices, but only 50 to 55% of companies in Europe have reported, but only 60% of companies have beaten, so a lower proportion of companies in Europe. And the earnings in Europe are actually down modestly year on year, which that's in part because of energy has a higher weighting in European indices. And also, I think the luxury companies, some of the consumer goods companies have been hit. So, you'd say that was a pretty healthy backdrop, particularly in the US.
I mean, US companies are very good at guiding analysts, and there have been revisions from the beginning of the year ahead of these numbers. So they are beating lower bars exactly. But
just play the game.
Yeah, but the US is very good at doing that. The classic beat and raise. But, the beat is against a number that they've already essentially told the analysts what it is. So they are very good at playing the game and better than European counterparts. But EPS percentage year-on-year growth of 10% is not unhealthy, is it?
Not to be sniffed at. And it's ahead of what we would ordinarily
ultimately, as our listeners I'm sure are very aware, earnings per share growth and earnings drive share prices in the long term. So
exactly right.
At 10%, what does that do to the market? Probably
which is partly why, and some of the commentary has been okay from companies as well, isn't it? So again, if you're looking at it from a sort of macro, what does this tell us about the economy? You'd say it was pretty good. The other interesting aspect of this, and we're not going to stick this up, but the Magnificent Seven companies, as we've talked about ad infinitum, they have seen 26% growth in their profits. The 493, i.e. the rest of the S&P 500, have only seen 1% increase in their profits. So that 10% figure is pretty much all the Mag 7.
And we are, we've seen this more recently as well. You can have, the classic 7-year cycle. You've got cycles within different sectors the whole time. Because if you look at consumer, it's not having a great time. But then if you look at tech, is having a great time. You know, banks are having a good time because of interest rates.
Yeah. Healthcare poor.
Healthcare's poor. You know, industrials.
Energy is poor.
Exactly. It is quite diverse, isn't it, with what's going on?
And as I sort of said to you and Ben the other day, I mean, if we go back to 2022 when the stock market was getting hammered, and in particular big tech was getting nailed, it was the other way around.
Yeah, it was.
Energy was flying. Banks were doing okay because rates were going up. But technology, you know, Microsoft sacked 15,000 people. Facebook sacked a similar number of people. And the share prices got massacred. So, you know, we'll talk about the stock market or the economy, and we do seem to have two, don't we? We have the tech sector and we have the rest.
We do.
And the advent of ChatGPT et al. Has really kind of lit a fire under, in particular, the Mag 7. And in fact, we've got some charts here on that. So the right-hand chart here just shows the relative return of US technology versus the rest of the market. And we can see that into this kind of tariff announcements in April, US tech was underperforming. But since then, and since the earnings season has kicked off, you know, tech started outperforming quite meaningfully again, driven by the
Well, a lot of the rhetoric from Trump was about getting middle America going again and getting small and medium-sized businesses, you know, really roaring ahead. And I think, you know, I think we bought into that, didn't we? As, you know, that the next phase of growth was going to be kind of those companies exposed to domestic America, and maybe it was time for some mid-cap, small-cap to start doing better. And then, of course, tariffs ruined that very quickly. So it's back to the tech game again. So, you know, for all the people that voted for the government, who were expecting, I guess, the rollout of, you know, the next phase of this cycle, it just hasn't happened. And we've gone back to being reliant on, you know, a handful of companies again, haven't we?
Yeah, and on that, it's this chart here that our colleague and learned friend Freddie has produced for us, concentration of the Mag 7. So the Mag 7 now make up 34.5% of the entire S&P 500. We should also remind ourselves that the S&P 500 makes up 2/3 of the global equity market. Yeah. So we are talking about, you know, quite a 17-18% of the entire global equity market in 7 companies. Nvidia itself is 8.2% of the entire market. Microsoft is 7 and a bit, and Apple's nearly 6. You know, these are massive numbers, but they are massive businesses. And just the final chart on a kind of big tech and has been what has driven the market, in particular in the last 6 weeks from earnings season, has been announcements from Amazon, Meta, Google and Microsoft, the so-called hyperscalers, about how much money they're going to invest over the next 12 months. Because they're all building data centers, they're all building AI tools and AI software. We're all using ChatGPT a lot more. You know, use is going up pretty exponentially. And the amount of money that these guys are investing is also going up exponentially. So 2023 capex of these 4 companies combined was 150 billion. 2024 that number got to 230 billion. 2025 it's estimated to be 325 billion, so more than double 2023 levels. And then 2026 that number looks set to be 350 billion. Chart courtesy of our friends at Baird. Shout out Ross Yarrow for this, who's done a good job of putting this together. But you know, where is that capex going? Well, it's going into sheds to build the data centers, the chips that go into the kit that you need to run ChatGPT and Copilot, etc. I mean, this chart's absolutely staggering, isn't it?
And of course, as we use, you know, I think for the first time ever, Google had, you know, on search, there was actually a fall in usage, wasn't there?
Yep.
But as people use ChatGPT and you know, others more, you know, the requirement for faster, more powerful chips is just going to increase. And I think, I don't know, I still don't, the majority are still not using these sort of AI tools. I think, you know, I don't know what percentage are using it, but there's a lot more growth to come potentially, isn't there?
Personal anecdote, time.
Go on,
Jackson. My TV remote wasn't working 2 nights ago, and historically what I've done, shouted, thrown it across the room, or maybe
Blame
gone
George.
on to Google. The problem with going onto Google and searching on Google is that you then have to go into websites which just throw ads at you, and the information you need is buried somewhere. So ChatGPT, my remote isn't working. Come out with a checklist. Check the batteries, done. Check that the infrared light's working, that's fine. Check that there's nothing in the way of the TV, fine. So then I've done all that. So then it gives me another set of instructions to follow, and then asks me for the model of the TV, and then it said, give it a wipe, do this, do that, do this in chronological order. Yes, try that, and then the fifth thing I tried, it worked, and the remote started working, and that was really painless compared to
Google
driving around Google trying to find the right page. So as people got more comfortable doing this sort of stuff, normal search moves on to there. You do need a lot more computing power for that, because it is quite powerful. So this chart shocks me, but it sort of doesn't surprise me in the same way. And there's a reason that Nvidia is now 8% of the S&P 500 and worth 4.5 trillion, because most of this capex is going on chips.
Yeah.
But the rest of the market, a little bit more lackluster. Just a sort of reminder for people that yes, you get these magnificent companies in the US, but you are kind of paying for them in valuation terms. So the valuation on the US market following the recent run-up is now at just shy of 23 times earnings on a 12-month forward. Yeah. Obviously skewed by the Mag 7, which are a premium.
And we're getting close to that peak in 2020 when all everyone wanted was digital businesses because we were stuck at home, and everything, forward earnings all got brought forward and everyone got very excited, and ultimately,
got blown up.
Yeah, and part of it as well was the interest rate story changed, and obviously inflation came through, and the dynamics are slightly different. But when forward PEs get to this sort of level, earnings really have to deliver.
They do.
And as earnings deliver, obviously the PE will come down. But so it's not. This isn't a signal that everything has to be sold. It's just a signal that earnings have to, or companies have to deliver earnings, and they have to grow into their multiples and valuations.
I mean, perhaps it's a sort of question for Ben, but like you take a company like Microsoft or even Nvidia. Apple's not a good example, but what should that company be worth? Yeah. It's got a company continues to grow at 15 to 20% a year. Microsoft, dominant. Copilot will eventually be okay. It's not the best, but it's for companies, it's the only option of installing it across their user base. Well, it shouldn't be on a market multiple, or it shouldn't be on 16 times, should it?
No.
But should it be on 40 or 50 times as it was in 99, 2000? Probably not.
Yeah.
So, is the number 30? Is it 25? Is it 35? Well, I don't know, somewhere around that. So, you have to keep that at the back of your mind. But European and UK stocks still at a pretty healthy discount, and by no means expensive. And you've got different drivers in those markets. For sure. European defence in particular, consumer staples, luxury, energy, materials, mining, etc. Very different. Industrials, very different kind of sector allocation. Equity markets are getting into that kind of post-COVID bubble kind of territory. I don't think we quite have the same amount of silliness, which brings me very neatly on to topic 4 at the special request of our learned producer here. Company that not many of you might have heard of, Palantir Technologies. Now,
Alex is going to explain what they do, isn't it?
No. Easy. What do Palantir Technologies do?
This is a question to me, isn't it?
This is a question to you, yeah.
So it's a bit of a black box, isn't it? But essentially they're a massive data analytics business. So they have the ability to process huge amounts of sensitive data, and they have big contracts with we've got some banging around the room. They've got big contracts with US government. So whether it's the defence, a lot of their work is done in very secretive kind of defence analytics. So there's not a huge amount of transparency over what they're actually working on, but we can see the revenues. The revenues just hit $1 billion.
The revenues just crossed $1 billion, in their results on Tuesday night, which is why the stock, as we can see, in 2 years, the stock's gone from $20 to $170. So a cool 10x.
Yeah, but you you know, when it's government contracts, they don't change these contracts quickly. They have to work with businesses that they can trust, particularly when it's incredibly sensitive information. So the market likes the story because the contract should be very sticky. It does something that not many other businesses can do. And yeah, I think the other point that we were talking about earlier is it's very underowned by
People haven't heard of it, have they?
Yeah, well, it's not. It's just very expensive. So I think if you're a long only investor institution, it's not a huge percentage of the S&P. So it's been large. Well, it wasn't.
It wasn't.
It's been largely ignored. But you know, it's very underowned from active managers.
So I pulled this out of Workspace this morning. This is the MSCI USA index. Companies ordered by market cap, top to bottom. We can see Nvidia at the top, 7.9% of the index. Microsoft, Apple, Amazon, Meta, Google. There's 2 lines for Google. So what we see is at number 21, technically it's number 20 if you take out the 2 listings for Google. Alphabet. Palantir is the 20th biggest stock in the US market with a cool £390 billion market cap. Am I right in thinking that the biggest stocks in the UK market, Shell and Astra, have got 150 billion sterling? Is that roughly
right? Market cap.
So they'd be about $200 billion. So Palantir is nearly double the size of the biggest stock in the UK market. Yeah, just for reference. And it's bigger than the likes of Procter & Gamble, Bank of America, Home Depot, just in behind Costco and Exxon and Johnson & Johnson. So pretty rarefied company for a stock that not many people will have heard of. Allegedly, there's a fascinating video on YouTube about what Palantir does, which again our friend Ross Yarrow sent around to us. I might link that in the email that I send out for people to go and have a watch.
He might explain it slightly better than me.
No way. Possibly comment. So there we go. So any of you who are keen on speculative stories and stocks that go up a lot, Palantir is one to have a look at, but we're definitely not giving any advice as to whether you should be buying it or not. No. Just to put that in there. So I think that's sort of a unique...
What price to sales multiple is it on?
Well, it's on 100 times sales, isn't it? Because It's just on $1 billion of sales in a quarter. So you quadruple that, it's 4 billion sales in a year or 400 billion market cap. Yikes.
Fair multiple.
Oh, who knows? Well, maybe they do 100 billion in sales in 2 years' time. You don't know, do you? That's what the market is expecting, which is why the share price has gone through the roof.
Yeah.
Good, Husey. I've got a meeting in a minute. Anything else we wanted to talk about? I mean, there's so much for quiet,
I think so.
Quiet summer months. It's been pretty hectic.
Got any more holidays?
Back to my parents' farm in Pembrokeshire tomorrow with just George and I.
Nice.
So we're going to do some farming. George is going to sit on the combine with Uncle Paul.
It's like tractor Ted.
I'll be tractor driving probably. I've been told that there's plenty of work for me to do.
Very good.
And then that's pretty much it. How about you?
We've got a couple of days in Chichester. My sister lives in New Zealand, so she's over for a few weeks.
Nice.
So it'd be really nice to see her and her little girl. So
any sailing?
Yeah, we will go sailing for the day.
Cool.
Take the stand-up paddleboards as well.
Yeah.
Watch my wife fall over as usual, which is my favourite bit. Sorry, Amanda.
Classic.
No, we're looking forward to that. So just a few days on the south coast. It's actually over the bank holiday, so I think we've got Thursday, Friday, and then we'll be there for the weekend.
Lovely. Bank holiday's early, isn't it? Bank holiday is about 25th or something.
Exactly.
So it'll be back to school time, won't it? So who knows?
Other than that, it's all work, no play.
Yeah, right. Good. All right. Thank you, everyone, for listening today. Any questions or feedback, let us know. He's james.hughes@courtachievia.com, jonathan.raymond@courtachievia.com. And we hope to see you next time. Thanks very much.
Thank you.